Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka, and my colleague here, and the birthday boy, Yatin Mota. Well, Yatin, a very happy birthday to you from me and the entire team.
Thank you.
Just want to point out, Yatin, the Bulls got a whiff of your birthday midday around. You know, that's why right after the cake cutting, we saw the recovery take shape, and we managed to recover very smartly from the day's low. In fact, came very close to that 23,700 mark as well. So yes, Yatin, how do you feel? How old have you become, Yatin?
So I don't know if I have become old, but I have become wiser. And yes, as you were mentioning, today was my birthday. Markets were brutal in the first half, but second half we managed to get some good recovery. And IT stocks, Nandita, they were clearly one of the outperformers in trade, because of which the market saw a good recovery. Overall, a great satisfactory day with the bulls probably taking charge of the markets with a brutal sell down for the last two trading sessions, especially in the mid caps. Today was some bit of relief rally in the second half.
That's true, Yatin. It wasn't turning out to be a great day, when we started off. It was a triple-digit loss coming in on the index and looked like we would violate that December low of 23,460 at one point. But very good recovery, as I said, coming in. In fact, even the mid-cap index, although it ended lower by about 1% or so, we saw a good 1% recovery from the day's low for this index. Aside of that, if you look at the advance decline ratio, firmly in favor of losers, as has been the case in the last few sessions, but still, nothing to complain about given the kind of recovery we saw in the second half. IT, as you mentioned, smart recovery, recovered 2% from the day's low. In fact, TCS, which officially kickstarts the earnings season tomorrow, ended near the day's high. In fact, it ended higher by about 2% or so. So yes, good recovery coming in IT stocks. Most of them were trading in the green by the end of the session. FMCG was another pocket that saw good gains, good recovery from the day's low. In fact, the FMCG index recovered over 800 points from the day's low. Banks also saw a good 400 to 500 point recovery from the day's low. So yes, a day of recovery. And if you look at the individual movers, it was clearly being led by some of the oil and gas counters, right? ONGC, that saw a good 4% up move yesterday. Today as well managed to rake in a 3% gain. So in the last two sessions, ONGC has gained almost 7%. Reliance Industries, bullish notes coming in from brokerages, and the stock was reacting to it. Top contributor to Nifty's gains today. In fact, Nifty's recovery today. That stock was the second top gainer on the index. TCS, ITC, Asian Paints, BPCL, Wipro was some of the other movers. In terms of losers, you had stocks like Apollo Hospital, Trent, Bajaj Auto, Shriram Finance, Ultratech, Cements, etc. But Yatin, even though the broader end of the markets were under pressure, we saw the MFI stocks outperform. And how? Look at some of these stocks; they're up somewhere around 12 to 14%. And what are the other movers that you saw in the broader end of the markets?
So yes, MFI I think did well. In fact, yesterday's star performers Spandana Spurti from the pack today also rallied around 15% intraday. But not a great day for mid caps, almost 1% down for the mid cap index, 1.5% plus down for the small cap index. And if you look at the advance decline ratio also, that was almost 1:2. So one advancing stock and two stocks declining because of the decline in the mid cap stocks. What was doing well in the mid cap end of the market was Credit Access Grameen and the stocks like Spandana Spurti, 10-12% kind of rally seen there. Stocks from the real estate space like the Phoenix Limited, Anantraj, both of the stocks moved anywhere between 6 to 8%. What was not doing well is the likes of Dixon Technologies down 9%, Paytm down 8%, and KC International down 7%. So these typical stocks saw some heavy profit taking which kicked in. Stocks like Apar Industries and Jubilant Ingreva also witnessing some big sell-off because of which there was pressure in the markets. Stocks like Bandhan Bank, Astral, Kajaria Ceramics down 2% each, and stocks hit fresh 52-week lows. So there is no out of the woods like stocks pertaining to the MFI segment, which is Bandhan, and also stocks like Kajaria Ceramics and Astral, which are into building materials, are not doing well.
All right, those were some of the movers and shakers from the broader end of the markets. But then let's focus in on the IT space, Yatin, given the fact that we have TCS reporting numbers tomorrow, and that will set the tone for the overall IT industry in terms of earnings. It is a seasonally weak quarter, the third quarter for IT giants, given the fact that, we see, a lot of employees going on furlough, and, that kind of impacts the revenue growth for IT firms. So higher furloughs, amid lower billable hours rather, these are some of the factors that will be impacting numbers. Although some recovery is expected, or broad-based recovery is expected in the US BFSI space, right? Especially after Trump's victory, right? Because of the kind of corporate tax changes that he's going to be bringing about. So that's one thing that led to good management commentary as well. In fact, if you look at some of the brokerages, they have now turned overweight, and over the last 6 months, we've seen IT stocks doing well, giving rise to optimism that revenue growth, the worst of the revenue growth, may have already happened for IT names. In terms of expectations from individual names, Infosys is expected to see a revenue growth of somewhere around 1% or thereabouts on a quarter-on-quarter basis. It may also raise its guidance from current 3.75 to 4.5% to 4.5 to 5%. If you look at the major brokerages, Kotak sees Infosys raising guidance to 4.5 to 4.75%, CLSA at 4.5 to 5%, and UBS at 4 to 5%. So, some kind of guidance revision is expected from Infosys. Talking about TCS, which reports earnings tomorrow, it is likely to see a marginal decline in its revenue growth on a quarter-on-quarter basis. Also, the fact that revenue from BSNL deal is expected to moderate because the peak revenue contribution happened in the second quarter. So revenue will be under some bit of pressure for TCS on that front, but it will see some bit of margin expansion because of that, because in absence of any deal-related costs, BSNL deal-related costs, and also the fact that it had already undertaken wage hikes in the first quarter. So there will be absence of any impact of wage hikes as well for TCS. Of course, there will be management commentary on the demand environment and consumer discretionary spends as well. Those are some of the factors to watch out for in terms of TCS. Also, in terms of deal TCV, lack of any big deals would lead to a deal TCV of somewhere around $9 to $10 billion according to brokerage estimates. So in terms of deal TCV also, you'll have to watch out for how TCS fares. In terms of Wipro, negative growth is expected. Q4 guidance is seen in the range of minus 0.5% to 1.5%, vis-a-vis the current minus 2 to 0%. So there could be some bit of guidance revision for Wipro as well. HCL Tech is one outlier because its products business typically does well in the third quarter. So on the back of that, a robust revenue growth of 4% could be expected. In fact, it is also likely to raise its organic revenue guidance to 4.5% to 5% from the current 3.5% to 5%. Aside of that, the rupee tailwind is also emerging for IT names. Yatin, rupee has been consistently hitting record highs, which bodes well for IT firms. So, because of that, margins could see some uptick for IT firms. But, in terms of the consumer discretionary environment, there hasn't really been any kind of an improvement, because Accenture had already indicated that. So commentary on that front will be watched out for, because Accenture did revise its guidance upwards, but that was not because of some big deal win, that was because of the deals it had won previously.
Correct.
So that's something to watch out for. In terms of other things to watch out for, performance across stress sectors like telecom and manufacturing, these are some of the things to watch out for. Even hiring trends. Infosys also had reported a headcount addition in the last quarter, and for TCS it was the second straight quarter of headcount addition. So hiring even for Accenture had taken place. So whether there's a pickup in hiring trend or not, that's something to watch out for. Outlook for revenue and demand growth, consumer behavior post Fed rate cut as well, Yatin. And now the fact that the rate cuts from Fed will be slower going forward, that's another factor. We'll have to see how IT companies take that in their stride. If you look at the IT sector performance overall, it has delivered a 20% plus returns for 2 consecutive years. In fact, Nifty IT is now trading at one standard above its 5-year average PE. So valuations wise, they are a little expensive now because they have outperformed Nifty as well in 2024 as well. Stocks have rallied, despite EPS cuts. You've seen a stock like Wipro also rally quite a bit, right? So yes, any disappointment could trigger sharp reactions, right? So yes, keep IT stocks on your radar. Tomorrow is the day when TCS kicks off its earnings, but that will be post markets, right, Yatin?
Absolutely, post markets. And before the big results of TCS Infosys come in, today we saw buying in IT stocks, which was supportive of the entire market recovery. But what was also supporting the markets is big boy Reliance Industries. For the past 2 trading sessions, we have seen the stock gain more than 1.5%. Today also 2 brokerages came out with buy notes on Reliance Industries, wherein we have a good amount of traction. Jefferies and Bernstein, these are the 2 brokerages which have come out with a note on both the telecom as well as the retail business. In fact, Bernstein has an outperformer call on Reliance Industries, target of 1520, and Jefferies has a target of close to 1700. Now, Jefferies believes that from here on the oil to chemical, which is the O2C business, will see some earnings recovery. In fact, they are also expecting value unlocking at Reliance Jio, which is the telecom business, as well as Reliance Retail, which is the retailing business. Now, if you look at Jefferies, they say that Reliance as a stock has underperformed Nifty by 15% in FY24, and probably from here on, given the valuations which are at a 3-year low, we could see some respite in the stock price. Also, if you look at Bernstein, they say that the Jio ARPU increase of 12% without tariff hikes and subscribers is about is of 4 to 5%. Also, if you look at the telecom and retailing business, we also could see the refining business margin rebound for the coming quarters, which makes a good value proposition at current market price. So, both Jefferies and Bernstein giving positive views on Reliance Industries, but a standard disclaimer that money control is owned by Reliance Industries, and hence you need to consult your financial advisor before taking any buy or sell positions in the counter.
All right, bullish notes coming in on Reliance Industries, of course, which has been underperforming, but looks like 2025 would be a year of recovery, and of course, all those factors that have been pointed out by brokerages could bode well, and of course, valuations wise also they've pointed out that it's pretty much attractive, and the risk reward also looking very good at the current juncture. Another space that has been in focus, Yatin, is autos. And we've had conflicting reports as to how festive demand panned out, but despite the fact that it was festive season for December, according to FADA, sales weren't all that encouraging, but for overall 2024, sales were pretty good. Auto sales on the whole were pretty good, but today we had a Jefferies note on autos, and they are preferring two-wheelers and tractors when it comes to the auto pack. Jefferies has pointed out the two-wheeler pack particularly is poised for stronger growth, and why not? Because we've seen pickup in rural demand, right, which is what is leading to an uptick in two-wheeler sales as well. But on the other hand, we have seen urban consumption demand slow down, and that is why we've seen passenger vehicle sales also slowing down and inventory pile up at showrooms as well. But according to Jefferies, two-wheeler demand lagged passenger vehicles over FY21 to FY23. And two-wheeler wholesales grew 14% on a YY basis in FY24 versus 8% for passenger vehicles. So the complexion started changing FY24 onwards. And here on, over FY25 to FY27, two-wheeler sales are expected to grow 13% according to Jefferies, whereas the growth in passenger vehicles would be somewhere around 8% over the same period. It has also, listed out some of its top picks from the auto space, and those are stocks like Eicher Motors and two-wheelers, and TVS Motors, I beg your pardon, in the two-wheeler space, and these are rated as buys by the brokerage house. Now, the brokerage believes that TVS is expected to deliver the strongest 30% EPS CAGR or compounded annual growth rate over FY24 to FY27, and it expects Eicher to deliver 16% EPS CAGR over the same period. Now, it has, of course, given a buy rating on Eicher, but target price has been jacked up and by quite a bit, 6,600 rupees. That's the target on Eicher, which shows a potential upside of 28% from yesterday's close price. For TVS, the target is at 2,050 rupees. Although it still has a buy call on Hero Moto and Bajaj Auto, those two stocks have been under pressure, I think, in the last 6 months or so. But the target price there has been scaled back a bit. If you look at the tractor industry, they say that this particular industry is also poised for very strong growth. After the pickup in rural demand, M&M, as a matter of fact, has been gaining market share in tractors and light commercial vehicles. It also believes that M&M will surpass Hyundai to become the number 2 original equipment manufacturer in PVs by FY27. It has a buy buy rating on M&M, and the target price has been raised to 4,075 from 3,700 or thereabouts. M&M has also been in news because it has announced the pricing for top EV SUVs, right?
Correct.
BE6 and XEV9E. The prices are at 26.9 lakh starting ex-showroom. And even Motilal Oswal has pointed out that the newly launched EVs will establish M&M in the EV market.
Correct.
In fact, the company is also aiming to clock sales of somewhere around 5,000 per month from the get-go. So yes, M&M has been in news, and in fact the stock has done very well, Yatin. Last year it was up 90%.
Top Nifty.
Yeah. So yes, that's the outlook on autos. Two-wheeler and tractors expected to do well going forward.
Well, that's M&M and a couple of exciting products, as you were mentioning. Two electric vehicles priced close to 30 lakh rupees. Market was expecting some aggressive pricing, but I think the kind of product that they've launched, probably volumes of 4 to 5,000 per model per month is quite possible. Further buoying the earnings as well as the resultant share price.
Sure, Yatin. Before we wrap, Yatin, just want to understand, are we going to see you tomorrow? You may have some big party plans tonight.
No plans. I'm a teetotaler, and I'll keep it simple.
Keep it simple, and yes, good to know that we'll see you tomorrow. That means you are getting older and wiser. So we are happy about that. But with that, we've come to the end of this edition of Closing Bell. Thanks a lot for watching. Of course, tomorrow is another day. We saw a good recovery coming in. Let's hope that we can build on that recovery, and we could see some bit of green on the screen. With that, thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates.